Hello and welcome to the Alt Asset Allocation Podcast. Today's interview is with Matt Bowles. This is the second time Matt has been on the podcast. The first episode was episode 8, way back in September 2020. That episode is a great one for someone interested in investing in rental properties or single family rentals. It was a very, very good one, and I share it often. So now, 20 months later, I figured it was a good time to have Matt back on and talk about the real estate market. Rising interest rates, supply-demand imbalance, globalization, demographic changes, technological changes. There's been a lot that's happened since September 2020, and these things really impact the rental investment strategy and real estate in general. So now there's a lot to think about if you're still on the fence about buying your first rental property, and I thought it was about time to have Matt back on. I really enjoyed this conversation with Matt on real estate. It's something I could talk to him for hours about. If you get any value from it, please share it with someone who you think it would help. And I'm always stoked for feedback. So shoot me a message and let me know what you think. All right, Mr. Matt Bowles, enjoy. Matt, welcome to the Alt Asset Allocation Podcast, round 2. Good to see you,
Ben,
sir.
great to see you, brother. Always a pleasure. Thanks for having me.
Of course, you're always welcome. So I told you before, but like when I have friends or people interested in investing in rental properties or real estate overall, I point them to our recent or our previous episode. So it was episode number 8, and it was recorded in September 2020. So this is being recorded in June 2022, rather. It's been a while. But that was a fantastic interview. I re-listened to it prepping for this. So still a lot of like timeless classics there. So would encourage all the listeners who are interested in investing in rental properties, like as an investment strategy, to probably listen to that one first. But I wanted to have you back on to talk about the real estate market overall. It's crazy. Interest rates are going up. The whole world's melting down. And we'll get into all of that. But before, for those guests that haven't listened to episode 8 yet, can we do a quick intro on who you are, where you are, and then we'll get into all the good stuff.
I am currently in Lisbon, Portugal at the moment. I just missed you here recently, unfortunately, hanging out with some of our mutual friends. Always fun to spend the summer in Portugal. So I am here because basically I'm a digital nomad. I've had no permanent base since 2013, and I've been running my business remotely, traveling around the world, living in cool places, all that good stuff, which is how you and I met. And I first interviewed you on my podcast. I host the Maverick Show podcast, where I interview today's most interesting location-independent entrepreneurs and world travelers, of which you are certainly one, Ben. And so,
well, no longer. I'm not. I have a location, but yeah,
you're still a
at
world
heart.
traveler, though, man. I look at your Instagram. You're in Greece. You're in Lisbon. You're all over the place, man. I mean, base or not, you, sir, are an interesting traveler. Nonetheless, so you and I connected over that. I interviewed you. You then interviewed me on your podcast because my company is Maverick Investor Group. We are a US-based real estate brokerage, but we serve real estate investors exclusively. So we don't list homes for people to live in or take buyers around to find houses to live in as a primary resident. All we do is help individuals buy cash flowing rental properties as an investment. And all of those rental properties are turnkey, which means that they are fully renovated single family homes, and they already have tenants in place on a long-term lease, and they already have a local property management company in place, collecting the rent, handling the maintenance, all of that, so that you get all of the benefits of owning the deeded real estate. You actually own the physical house yourself, but you don't have to be the rehabber or the landlord or live near the property. So you can buy and own in the most investor advantaged US real estate markets, regardless of where you happen to live yourself.
Yeah, that's a great intro, and I mean, we were talking beforehand, but I've had a number of friends buy numerous properties from you at Maverick, and they're happy so far. So in all virtual or remote, which is super cool. So you're in Lisbon now, obviously a big fan. And then where are you headed next?
I'm on my way to Bansko, Bulgaria to speak at the Bansko Nomad Fest, which will be a super fun event. You and I both will know a number of people there as well. I've had a number of my podcast guests who are also going to be speakers at that event. So I will see a lot of old friends and meet a lot of new cool people. But I'm going to be there talking about real estate investing for digital nomads and how to buy cash flowing US rental properties from anywhere in the world.
Awesome. No, good stuff. And Bangsko, I mean, comes up because a lot of digital nomads like have purchased properties there. I think it's got good skiing in the winter, but like you can buy an apartment for like $50,000. Just and I don't know what the property rights are like, but you have a place for 50K, which is probably about where your doormat goes in Los Angeles. You get an
Yeah,
entire
and
place.
it's also a popular destination for nomads because the cost of living is so incredibly low. I mean, it's like going to Chiang Mai in Thailand or something like that, where you can rent a fully furnished apartment for a month for like 300 euros, something incredible like that. And so the cost of living is so low. And then, as you said, the quality of life is great, right? If you go in the wintertime, it's a ski town and you can just walk over to the ski lift, go up and do your skiing. If it's in the summer, you've got hiking, you've got great outdoor stuff. You've got even wineries and stuff in Bulgaria that you can go to and really cool stuff like that. So I've been once before. It was in the wintertime. And this time I'll be there in the summer. So looking forward to checking it out. I'll stay longer this time and be some fun peeps to hang out with.
Awesome. And I'll probably reference back to that $300 a month thing because I mean that's like a day in an apartment in LA. And I think it's part of like this bigger macro trend of work from home and people kind of shopping for the best deals, but like from a living perspective. But it's like the Andrew Henderson nomad capitalist, like go where you're treated best sort of mentality. And I think the rest of society will kind of wake up to this, that you've been obviously living and walking the walk since 2013. So you're certainly familiar with it, but and I think I've probably jammed it down the throats of the people of my podcast or my friends enough, but we'll touch on it again. But until we get there, uh, housing market. So one of the things that we stressed on the last podcast is it's difficult to talk about the entire real estate market as if it's like the stock market. In reality, there's no one real estate market, but it's that specific neighborhood where you live or where that house will be. And that's kind of its own little market. But there are ways to kind of talk about the overall real estate market in general, without saying like everything is going up. So let's start by kind of setting the stage. Right now it's mid-June 2022. Give me the state of the real estate market right now.
I mean, the short overview is that the trends right now are incredibly powerful if you are a real estate investor, because the first thing that you want to observe is the supply demand imbalance in the housing market. That is the first thing that should stand out and that you should observe immediately. Okay. So prior to the pandemic, the normal amount of, homes available for sale on the market, right? Available inventory might be 1.5 million or so, right? 1.5 million ish. Right now, there are, I believe, about 500,000. So we're talking about a third of the normal available inventory is currently available. So you have a severe supply shortage, right? And there's a number of reasons for that. One of the reasons, of course, is that there have been supply chain backups, right? There have been labor shortages in terms of being able to build new homes to meet all the demand, all of this kind of stuff. And so the severe supply shortage versus demand has been causing for quite some time now, and still today as we speak here, home prices to rise in value, right? And so if ever you have a supply and demand imbalance like this, you as the investor want to be on the supply side of a high demand equation, right? So that, I think, is the first thing to look at. The other thing that is incredibly profound and important for real estate investors to understand is the inflation situation that is going on right now. And one of the things that we talked about on the last episode is the way that homes, rental properties I'm talking about, are, first of all, you have they're indexed to inflation, they're hedged against inflation, right? Because home prices rise with inflation and rents also rise with inflation. But the other thing that is incredibly impactful is that you are actually able to profit from inflation if you buy and hold rental properties and you take out a 30-year fixed rate mortgage, because you are borrowing that money in today's real dollars. And then as inflation rises, you are paying the bank back in future diminished nominal dollars that are worth less than the ones you borrowed. And so buying and holding rental properties over time actually creates this incredibly unique situation where you can move from being the victim of inflation, right? Where if you have all your savings in a savings account and you're making like 1% interest, but inflation is eating away at that at a much higher rate, all of a sudden it's just destroying your wealth. But if you buy and hold rental properties, you can now get on the other side of that equation, where instead of destroying your wealth, it's causing your home price to go up, it's causing the rent you collect to go up, and it is destroying your debt that you owe the bank, right? It is debasing that debt, and you're actually able to profit from inflation. So you flip the entire equation around. So that's a really important thing also, I think, for real estate investors to pay attention to and to understand the opportunity to profit from an incredibly high period of inflation this particular year.
Yeah, no, I think, and that's super, super powerful and great for those people that have already purchased a home and were able to lock in a 2 and some percent interest rate. And yeah, I mean, kudos to them. And not to mention like 60% rise in your house price probably. But so before, so thinking through the supply and demand imbalance, and this is mostly speaking from the US. So we'll continue just speaking about the US. I'm unsure other countries, but supply, presumably it takes a long time to kind of rebuild that inventory. It's not like you can snap your fingers and a bunch new supply comes on online. So would be curious on kind of the normal lag there. I would imagine this is a typical market that you see that there's low supply and now tons and tons of people are building houses. So in the next 2 years or whenever they're all finished, we'll have a big inflow of supply. But would also like to pick apart the demand piece of it a little bit and see kind of what are the risks to both of these in kind of changing this supply demand imbalance, which is really helping add rocket fuel to number go up demand for houses.
So one of the things that's really significant in understanding the supply imbalance is some of the other factors that are going on in the market right now. So you mentioned rising interest rates, okay? One of the things, and this may seem counterintuitive to some people, but one of the things that typically happens when interest rates go up, and you can look back over the last couple decades and you will find that in the last 6 times that interest rates were raised in the last couple decades, right, that they went up, you will find that correspondingly in all 6 instances, home prices also rose as the interest rates rose, right? And one of the reasons that that typically is correlated is because as interest rates go up, a homeowner that has a much lower rate locked in, right, is going to be encouraged not to sell their home, because they know that if they sell it and they buy another home, even if it's for the same price, they're going to have a mortgage at a much higher rate. And then their expenses to live in that same value home are simply going to be much higher, right? So it's a disincentive for people to sell their homes, and it functions to further constrain supply, right? So right now, the latest statistic I've seen is that something like 24% of the first lien mortgages right now on homes in the United States are locked in at under 3%. Okay, so if that's the case, then that those people are completely disincentivized. They're going to try to hold on to that mortgage at all costs and not sell that house, which is going to further keep all of those houses off the market and further constrain the supply, right? And you also have this incredible dynamic with regard to real estate where those people can actually access the equity in their home without selling it, right? They can take out a home equity line of credit, pull that equity out, not a taxable event, not a capital gain. And they don't have to get rid of the first lien mortgage and they don't have to sell the house and they can still access the equity, right? So these people are going to be highly disincentivized to sell that house and to put that on the market as available inventory. And so as the interest rates go up, it functions to further constrain supply. And as supply is further constrained, home prices typically are going to continue to go up. So that is an ongoing dynamic that we're still seeing right now as you and I speak.
That is absolutely fascinating. And when I hear this, I just think, oh God, like the person who's been renting, who has been saving up for that house, now rent rates are going up, and they're getting worried and thinking, oh, maybe home prices will actually crater because of some, I don't know, it's the opposite, just totally screwed. Like, but the other side is like somehow unlock massive supply, and then if demand stays the same or goes up, like it still, who knows what happens to the price, but probably trends down. So let's pick apart supply a little bit more. Like, how long are home builders just ramping up production and like there's a massive supply coming on, or are they all homeowners and they want to constrict the supplies because number goes up and pull out more equity and buy?
I mean, there's been, through the pandemic, as we've seen, right, as with a lot of industries, there have been labor shortages, there have been supply chain shortages in terms of materials and all of this kind of stuff. So the home building and all that is not keeping pace with the demand, at least at this point, right? And there's a lot of factors that are causing increased demand as well, right? Like there's increased household formation coming out of the pandemic era, right, Ben? I mean, there's a number of things that happened during the pandemic. One was that, couples had babies and they now need, more house, right? They need to expand their household. Another is that couples were breaking up and now all of a sudden one household becomes two households, right? Or roommates that were together for the whole pandemic are now, going to get their own places and stuff. And so there's a lot of, demand for houses. And right now the supply dynamics are not able to keep up with those. And a lot of the things that are happening right now are functioning to further constrain supply. And so you've got the increasing home prices. The other thing that you have is increasing rents, right? And if there's not enough homes for everybody to buy that wants to buy them, or their interest rates are too high now and some people can't afford to buy them or whatever it is, well, guess what? They're going to rent, right? And so that then puts upward pressure on rent, which drives rents up. And so the last year we saw a 10% increase in rents nationally, right? I mean, this is like significantly higher than the average. Normally, maybe each year you might see a rental increase, 2%, 3%, that kind of range. And last year we saw a 10% increase in rents, right? And so again, we go back to the real estate investor perspective, right? If you are on the supply side of a high demand equation and you have the asset that people want to rent, you have the asset that people want to buy, you have the asset that there is a shortage of, then that's exactly where you want to be. And you also have to remember that the actual intrinsic utility value of the single family home increased significantly during COVID. What do I mean by that? Well, normally it's like you think of a house pre-COVID, you think of a house, okay, this is where I live, I sleep, I come home after work and I relax there, I eat there. And that's kind of the function of my home. Well, during COVID, we learned that the home can also be the office. It can also be the school. It can also be, all of the other things that you do in your life. And so with this remote work trend, it has increased the utility value of the single family residence, right? And so for all of these reasons, these are really the trends that, that we're seeing right now, which is why it's so advantageous for real estate investors at this time.
Yeah, no. Well, okay. So I think a lot of my listeners probably fall into the demand category. So still wanting to purchase a real estate, they understand the value of having this other asset in their portfolio, income for the rest of their life. All of the things we talked about on episode 8 kind of got them over the line. But like now, maybe you shuffled your feet, maybe you're still on the demand side. So everybody's investing in the same market. So interest rates are 6%. Everybody's paying them that's buying them now. So, there's always deals to be found. It's just a matter of like turning over enough stones and like looking in enough places until you find those. So let's talk about some of the bigger macro trends in the US uh, impacting real estate. So work from home is a gigantic one. Um, uh, Demographics like boomers moving into the Sun Belt. Like let's talk about some of the biggest trends that you see impacting the real estate markets across the US right now.
Well, one of the biggest trends, demographically speaking, I think coming out of the pandemic that we just saw is what I would refer to as the de-densification trend, right? And so you're seeing people wanting to move out of apartment buildings with shared laundry rooms and shared elevators and shared common spaces and railings and all that kind of stuff and move into detached single family rental properties, right? You're seeing people moving out of crowded urban areas and move into suburban, places with more space, right? With a yard, with a detached home, that kind of stuff. And even if they're still renters, they would rather rent now a detached single family home than an apartment building in a crowded building. I mean, I think that's one of the things that COVID did. It started that trend. I think that trend has proliferated. And so when you're thinking about, anticipating that as an investor, that's one thing you want to think about. The other thing is, to your point, and what we started talking about in the beginning of this conversation internationally, which you and I have been doing for a while, which is this concept of lifestyle arbitrage, right? Like you and I are like, oh, we can make the same amount of money that we make, but we can go all of a sudden live in Thailand, and now we have Thailand living expenses, or we have Bulgaria living expenses, but we're able to make the same income because we work remotely. Ben, I know people that are doing that domestically. I know lawyers that work for a New York City-based law firm that have moved to Kansas City, Missouri, and are now able to have Kansas City living expenses with New York income, right? Or for that matter, people that have moved to, a more desirable lifestyle market, but it might be less expensive than, the place where they're making their money, right? And so those things are important to consider in terms of what does the remote work trend mean for where people want to live. People want to live in places where they have lower than average cost of living, but a good quality of life. So that cost of living, quality of life ratio, where that is very strong, that's another factor, I think, relatively new, or at least dramatically accelerated since COVID in terms of where those folks are going. And I think that dovetails with a lot of the real estate investing strategy, right? Because when you're buying rental properties, you want to buy them in exactly those types of markets, right? Where you can buy properties relatively low, rent relatively high, places where people want to live, where there's lower than average cost of living, but a good quality of life, and places where people are moving. So I think all of that comes into play.
Yeah, I mean, so just extrapolating that out further, it's like I'm in LA right now, which is just one of the dumbest places financially to live in the US, but it's got a great beach, and I have family here, so I'm just
I was there for 7 years in
yeah,
LA. It's a
yeah,
city that I dearly love, and it's expensive for a reason. Let's be honest. I mean, it's
yeah.
amazing.
Yeah, I mean, pros and cons of every decision, and this one definitely cons is the financial implications of living in a place like this. But yeah, so okay, step one is like move to middle of nowhere, USA, buy a gigantic house, make the same amount of money, like increase your margin and the amount kind of going to your personal bottom line, and you save more, retire earlier, whatever. But like taking that a step further is going abroad and like why would I live in Kansas City, Missouri and pay $1,000 a month on rent when I can live in Portugal and pay $300 a rent? And I can have an assistant and pay them $800 a month as opposed to $4,000 a month in the US. So are you seeing people start to like scratch their heads and think more globally? And from our last talk, I mean, real estate is the most tax advantaged asset in the US. So how do you start thinking about analyzing after tax returns, like when thinking about moving abroad and investing in real estate abroad versus in the US? There's a bunch of questions wrapped up into that, but kind of thinking through the decision making of like investing abroad because globalization will continue versus in the US.
So 100% of the rental properties that we help people buy are all in the United States, right? It's an incredibly highly regulated industry. It's really clear and specific in terms of how you buy, how you take title to the property, how you own that, how you handle a legal dispute, exactly what happens if the tenant doesn't pay the rent, how the eviction process works, how this, like, it's 100% clear. As you start doing things outside the United States, there's just a massive diversity of legal dynamics and how this works and what the implications are and what the all of this kind of stuff. And so Maverick Investor Group, 100% of the properties that we help people buy are in the United States, but people can buy them and own them from anywhere in the world. And so, as you mentioned, you and I have some very good nomad friends in common who choose, right? They might be American by citizenship and birth, but they choose to travel the world, live in other countries, do this incredible lifestyle, but they want to invest in those assets of the cash flowing US rental properties. And because they're turnkey through Maverick, they don't have to be there. They don't even have to visit the market once. They don't have to go to the market to close on that property. They don't ever have to step foot in that city. They can see pictures, they can see videos, they can hire independent home inspectors and independent appraisers and hire professional property managers on the ground. And we help them to do all of that, right? This is all a completely turnkey process. And then you can build your portfolio of cash flowing US rental properties while living your ideal lifestyle. And that's really what we try to help people do. And so there's a lot of these digital nomads. I'm told you I'm speaking at the conference next week on exactly this topic to hundreds of digital nomads, right? About people that are making these lifestyle decisions, but they want to help to finance their lifestyle by building their portfolio of these cash flowing assets.
Yeah, that makes sense. I mean, so up markets are easy. Everybody to make money, right? You throw a dart at any asset and it kind of goes up and to the right. Assuming that the market's getting a little choppy and maybe this is driven by macro or whatever. But what are the mistakes that you normally see real estate investors make when kind of the times get a little bit more difficult in these types of environments?
Not making their money when they buy and instead speculating on future price appreciation, right? So one of the things that we always encourage people to do is to make their money when they buy, and to do so by purchasing a performing asset that is already cash flowing and is already performing at the time that you close, so that whatever happens to the housing market down the road, if it goes up, if it goes down, if it stays the same, is not really going to impact you very much, because you have locked in a price to rent ratio that you are happy with. You are getting cash flow into your bank account every month. That tenant is paying down your mortgage principal. So you're building equity regardless of what the housing market does. You're still building equity because you have the tenant paying your mortgage principal down every single month. You are also taking your tax benefits, right? You're depreciating your property every month. You're saving taxes because you're taking that as a loss against your income, right? And so you're taking all of these benefits, right? The inflation hedge that we talked about, right? Your home price is going up, your rents are going up with inflation, and you're paying the bank back in dollars that are worth less than what you borrowed. So all of those things are functioning for you independent of what the housing price does, right? What the how much appreciation there is or there isn't. All of those other profit centers are still going to be functioning for you. And that's what you want to focus on. You want to say, I want to buy a asset that is performing and profitable from the day that I buy it. And whatever the housing prices do moving forward is not going to impact the profitability of my investment. And it's not even going to impact my psychology about it because I'm a long-term holder. I'm not trying to flip this, right? I'm going to hold this for 10 plus years. And so whatever the housing market does on paper in between then is not really going to impact me very much. And that's an important thing, because when you start getting outside of that, you start buying things that are not initially profitable on hopes that they will go up in value or you can sell them for more later. That's when you start getting into trouble, and you want to avoid that.
Yeah, easier said than done, right? All of these things you can kind of write on a sticky note or tattoo it on your arm or say it to yourself every morning. But having that long-term mindset throughout the storm is very, very difficult. And I'd say, I mean, what are the mistakes that these investors make, like psychologically, like that don't really make it? They never pull the trigger on real estate, or maybe they they just don't really they give up, they fail, or they never get started. What are like the psychological hurdles or issues that you see them make?
Well, I think if people want to find a reason not to do something, they can certainly find that, right? I mean, just Google something and everybody's going to have an opinion about why not to do this or that, why it's a bad time to buy this or that investment, why you shouldn't do this, why it's dangerous, why it's all this stuff. So you can always find reasons not to do things. And if you want to convince yourself to not do things, you can always find that, right? So I think that, what people need to understand is they don't want to. I would say people get into this trap sometimes of comparing things to what it was a short time ago, right? Oh, last year the prices were lower than they were now. I missed the upswing, right? Last year the interest rates were lower than they were now. I missed that, so now I have to pay a higher interest rate, so maybe I shouldn't buy, or I have to pay a higher price for the home, so maybe I shouldn't buy, or this or that. And so you start convincing yourself that, if only I'd bought a year ago, that would have been good, but now I've probably missed it, right? And I think that's the trap that gets people, because you'll always have that, right? You can always say, oh, if only I had done it at this other time, then it would have been a better deal than now, right? And so I think what you really need to do is to hone in on the fundamentals of what is going on right now. We are at historic levels of supply demand imbalance, right? Historically speaking, I mean, interest rates are not high, historically speaking, Ben. Interest rates are still low, historically speaking. If you actually look at the history of interest rates, right? They're just higher than they were a year ago, which is why everybody's like, oh my gosh, interest rates are so high. No, they're not. Not historically speaking, they're not, right? But what you need to understand is that interest rates are lower than the rate of inflation. They are lower than the rate of inflation, right? The official inflation report just came out a couple of days before we are recording this, and it was the consumer price index was at 8.6%, which a lot of people think is, much lower than it actually is, right? The rate of inflation. But even if you were just to take that number, interest rates are lower than the rate of inflation still now, right? So the thing that you want to understand as an investor is whatever the rate is that you're getting on your loan, factor your mortgage payment into your expenses and just see, will the rent cover it, right? Will the rent cover my mortgage? If the rent will cover my mortgage, then your tenant is paying down your principal and you're building equity, right? You're paying the bank back in future diminished nominal dollars. You're allowing the inflation to just debase that debt for you, right? All of these things are still working. And so I think it's really important to understand the advantages in a period of high inflation, right? In a recessionary period, to understand the advantages of moving your investment capital into those hard assets and holding those rental properties and allowing those profit centers to work for you.
Yeah, and I just wanted to share, so anybody watching this on YouTube, this is like the 30-year fixed rate historical average. So been in a pretty big downtrend since the 80s. So it's quite a big bump, but if you zoom out, it's so if you zoom in, yeah, it looks pretty disastrous, right? But like zooming out and to include the 80s, historically, it's still very, very low. But there is that like recency bias and that, oh, I want to kick myself that like I knew we should have pulled the trigger on that house last year for X minus 20% or whatever, and at an interest rate that was much lower. Uh, the thing, I guess it's like the inner contrarian in me that the thing that just always worries me um, about real estate is even in LA, right? Like $2,000 a square foot, which is just bananas. I was looking at things that were like $100 a square foot and abroad and thinking they were pricey, but $2,000 a square foot, and people rationalize it however they want. But here, it's the real estate always goes up in the West Coast, and it's just always going up. So of course, doesn't matter where you buy in, it will go up. So I mean, these like collective investing society psychological mental models are terrifying. So I'd be curious just your like contrarian takes on different markets or just whatever you have in regards to real estate.
Well, I mean, with regard to that, man, I mean, I think the basic fundamental approach is not to speculate, right? Like it's a little bit of a different mindset, right? Because most people, when they think investment, they think I'm going to buy something and it's going to be, usually it's a unidimensional asset, right? Which means the only way I make money is if it goes up in value. So I'm going to buy it. I'm going to hope and pray it goes up. I'm going to have very little control over it. I'm just going to hope and pray. And if it goes up, it has to go up more than the rate of inflation to be profitable in real dollars. And then when you sell it, you have to then pay your capital gains tax on what you made. And then whatever's left over, it has to be profitable that way, right? And so that's, I think, how most people think about an investment. And certainly if people are buying real estate in California, that's how they're thinking about it, right? Like I'm buying this as a speculative asset, and the way I'm going to make my money, because it's not going to be from positive cash flow, is going to be it goes up in value and later down the road I sell it, kind of thing, right? And so I think reorienting the investor mindset to rental properties is a very different thing because it is a multi-dimensional asset class, right? You can take home price appreciation completely out of the equation, and you can still have multiple profit centers working for you at the same time, starting the day that you close. And if you want to think about that as a risk mitigation hedge, you can think about it that way. Like you can frame it however you want. You can say, okay, if the market goes down, if this happens, I'm still collecting my cash flow. I'm still taking my tax benefits. I'm still building equity, even if the market is not going up because my tenant's paying my mortgage down. And if you want to call that a downside hedge, if you want to call that risk mitigation, if you want to call it just simply not having to speculate on this asset because it's a multidimensional asset that you can profit from regardless of what the market does, as long as you buy based on fundamentals, which means not buying in the state of California, right? It means buying in a place where you can actually cash flow and where the investor fundamentals actually make sense. And so I think that is the distinction, right? If you do that, that's how you get out of that mindset.
Yeah. So I want to go through this with you live. Man, I told you we'd just have a conversation, see where it goes. All right, surprise. So thinking about California, like some people I know in like a tiny little house, in Venice or whatever, it's probably worth 2.5 million bucks, which is insane. So if you were to buy that thing and put 20% down, and if people listening on the podcast and YouTube, you'll see what I'm going through, but I Googled mortgage interest rate calculator, California. I included taxes and fees, and I'm doing $2.5 million home price, 20% down at current interest rates, 30-year fixed 5.5. So your monthly payment would be almost $15,000. So if you were thinking about like investing in this in a like as an investment property, you would need to rent this out for this plus a margin, super simple numbers, right? Or you could like think about the 1% rule, and you're like trying to rent it out for $20,000 plus a month, right?
I mean, good luck.
Yeah. Yeah, but that would be the like how the math would have to work out in this property. So
Well,
I'm just thinking about my friends that are paying 6 grand a month, which is crazy for like a little 2 bedroom apartment. But like, yeah, do you think that they will end up paying 20? Probably not. So like thinking about it in terms of cash flows, that it just can never make sense.
Well, this is why the concept of geographical arbitrage is important here, right? Because let's say that you buy a $2 million house in California and you can rent it for 6 grand, something like that, whatever you can rent it for. So then now you have your price to rent ratio where you have $2 million of real estate that's generating you $6,000 of gross income, for example, right? Now, if you instead moved that $2 million into another real estate market, let's say St. Louis, Missouri in the
Or
Midwest,
Indiana.
or
Hey,
Indianapolis. Let's go,
yeah,
baby, represent.
also.
Move it into the Hoosier state.
Yeah, my parents would be so stoked.
You move it into a market like that, and now all of a sudden, right, in a market like Indianapolis or Kansas City or St. Louis or Baltimore or a market like that, now all of a sudden, you can buy. And St. Louis has probably been our most popular market over the last year, I would say, because in St. Louis, you can buy a detached single family home with a yard, 3 bed, 2 bath, in a majority owner occupied suburban neighborhood, fully renovated for 100,000 to 150,000 US dollars, right? And if you buy that $100,000 house there, you can rent it for about $1,000. So now, if you deploy that $2 million worth of real estate, you're buying 20 single family homes, but you're getting $20,000 worth of gross rental income instead of $6,000 that you would get in the example that we just gave in California, simply by arbitraging your real estate investment to a different market where the price to rent ratios are so much more favorable for investors.
Mm, yeah, and it's just a simple math exercise to think through those things, but a lot of people don't. And there's a lot of psychological. I mean, you want to own the place that you live in, and it's got a great yard, and you want to renovate the kitchen, so you can justify it however you want. I talking about places like Indianapolis, St. Louis, price to rent ratio is one aspect, but like what other characteristics are you looking at to find these it, it, uh, investor advantage locations?
Yeah. So places where, first of all, you've got the price to rent ratio, that has to be there, right? And then from there, you want to look at the expenses, right? How high are the property taxes, all of this kind of stuff, because you want to make sure that you are able to have your gross rent cover all of your expenses, plus cover all of your principal and interest payment of your mortgage, plus cover an estimate for maintenance and vacancy. Even if you close on a performing property that was newly renovated and the tenant's already in there, you're not going to have any immediate vacancy and maintenance, but down the road, as long as you're holding this property over many years, of course, you will always have maintenance and vacancy. So factor that in, amortize on a monthly basis and estimate that in. And then after that buffer, you should still have positive cash flow coming to you. So first and foremost, the numbers need to work. And then you want to be in markets where unemployment is lower than the national average, right? Cost of living is lower than the national average. People want to move there. Jobs are being created there, right? And so you have those positive economic indicators there as well. And then you want to pick those homes in the micro markets where the numbers make sense, right? Obviously, if you're buying in Indianapolis, there's insanely expensive homes there too, right? I mean, where the Indianapolis Colts live, you're not going to buy in that neighborhood, right? But there's also, neighborhoods that are undesirable because they're not going to be able to attract high quality tenants, and they're not going to be desirable for homeowners to buy that from you down the road because they're not going to want to live in that. So you need to buy in what we call the real estate investor sweet spots. So picking out the particular sections of these markets that are desirable to quality tenants as well as to homeowners so that you can buy and then you can have an exit strategy and then you can have a strong rental experience while you're holding.
Awesome. I understand that I need real estate, but I have reservations. It's like through something like Maverick Group of like, hey, the roof needs to be changed. This tenant, oh, we couldn't find a tenant for 8 months. This tenant had a meth den in the basement. Like these are the things, unrealistic or not, that worry me about like pulling the trigger on houses.
So the main solution to those concerns is hiring high quality professional property management, which is one of the things that you're going to factor in to your monthly expenses. Okay. Some people try to be a landlord themselves for any number of reasons, right? They want to control the process. They want to save money by doing it themselves and not hiring a professional or something like that. All of our clients are not trying to be landlords, right? They're trying to be investors, which means that they make decisions and they cash checks. They are not dealing with tenants and toilets and trash and all of that thing, which is the responsibility of the landlord. That is what you are going to hire and pay a professional property management company to do on your behalf. So you're going to review a agreement contract with them. You're going to hire them as your agent, your representative. The tenant in the property is not going to know that you, Ben Lakoff, own this house. They're only going to know that they have to pay the rent to this property manager. If anything is wrong with the house, they need something needs to be fixed, they call the property manager, not Ben, the property manager. And the property manager responds to that call and then fixes the item, right? So if there's something that goes wrong, they call the property manager sends over a maintenance person, they fix the item. You are going to be able to log into your portal on their website 24/7. And once in a while, remember, that's why we talked about factoring in that maintenance expense, because you might not have any maintenance for the first year, but then maybe the start of year 2, there's going to be a maintenance item, right? The tenant calls and says, this thing isn't working, I need it to be fixed or whatever. You're then going to see that on your monthly statement. So the rent comes in and the property management takes their fee out of that. And then if there's a maintenance item, they fix it and they take that out of the rent as well. And then they give you the amount that remains, and you're going to be able to see that every single month. And so this is why you hire the property management company, right? In terms of vacancy, in terms of releasing the property when the tenant moves out, this is all the role of the professional property company, which is not only a management company, it's a leasing company as well, right? So the first thing that you're going to do is you're going to buy right. So you're going to buy in a high demand rental area, okay? And there's different ways to verify that. You can talk with multiple property managers about how long does it take for you to lease out a property in this area that's like the one that I'm going to buy, right? There are also, online websites you can go to, like rentrange.com and things like that, and put in an individual property address, and it can show you, the vacancy rates in that area, which way they're trending, all of that stuff. So we help you to do all that due diligence up front. And as long as you buy right, you're buying in a high rental demand area, and you're hiring a professional company that does this professionally and has a track record of leasing properties and releasing them in this particular time period and all of that. That's their job. That's what you're paying them to do on your behalf.
Yeah. I mean, I get it. The logical mind of me totally gets it. But yeah. Also, as an entrepreneur with bumpy income, well, I would be curious. I mean, I think Tierney's got the similar situation. It's not easy to get a loan in the US. Like I've had an 800 credit score, just but then like my income is 0 for a year, and then like very little for a year, and then very high for 6 months, and then nothing again. So not the best from like a lender's risk profile perspective. So obtaining financing for somebody like me?
Yes. So there are different types of financing, and depending on who you are and what your situation is, there are all different options for you, ranging from the conventional financing, which is obviously going to be the most advantageous, right? The highest loan to value, the lowest interest rate, the lowest, fees associated with the mortgage, all of that stuff, right? If you don't qualify for that, though, which a lot of our clients don't, and there's a lot of reasons why. Some people might have too many mortgages. They might have more than 10 mortgages. Some people might be foreign nationals. They're not even Americans at all. They have no credit score. Some people might be trying to buy this rental property inside their self-directed retirement plan, and they cannot even personally guarantee it at all. They need a completely asset-based loan that doesn't take any of their personal qualifications into account at all. And so, depending on which category you're in, who you are, what your qualifications are, we will connect you with preferred lenders that specialize in lending on investment properties. And you can then try to qualify with them and identify which category you're in. Once you figure out which of those qualification categories you're in, they can give you a specific quote for you on this property. Here's what your interest rate would be. Here's what your down payment would be. Here's what your monthly payment looks like, etc. So whatever category you're in, we will help you to identify the lender that is right for you.
One day, sir. Until then, I'll be perfectly situated on the supply or the demand side. Great stuff. Well, Matt, we're butting up against the time. I could talk to you for hours about this stuff, I know, but wanted a quick update on a lot of these things. What else should my listeners know? Where else can they find out more about you, about Maverick? Where would you like to send them?
Sure, man. Yeah, I think, this year in particular that we are having this conversation, 2022, is one of the most advantageous years for buying a rental property because a lot of these advantages and these profit centers are being turbocharged, right? Home prices are going up more than the historical average right now. Rents are going up more than the historical average right now. Inflation is higher than a lot higher than the historical average right now. And all of those things you can profit from if you get on the investor side, the supply side, and you start owning rental properties this year. And so that's really important. And we are here to help people do exactly that. So Maverick Investor Group helps people buy performing cash flowing rental properties in these investor advantaged markets. So you get to leap over all of the upfront risk that goes along with buying distressed properties and renovating them and renting them out and all of this kind of stuff. And you just get to swoop in, do your due diligence on the property. So you're going to do your own home inspection, your own appraisal. We support you through all of that, but you're going to do it independently. And then you can close on a cash flowing performing asset and start collecting the cash flow the day that you close and have it professionally managed by a local company. So you don't have to live near it. You don't even have to come into the city to close. You can just close with a mobile notary that can meet you at your home, your office, your local coffee shop, or whatever. And so you can buy and own these rental properties from anywhere while actually owning the deeded real estate and getting all the benefits, but not having the landlord and the rehabber headaches, right? So that's our value proposition. We would love to connect with all of your listeners, anyone that's interested in this. They always have a VIP red carpet treatment at Maverick Investor Group. And so we've created a special landing page for listeners of this podcast. You can just go to maverickinvestorgroup.com/invest in alts. And we'll link that up in the show notes, I believe. And if you come there, we have a completely free white paper that you can grab called How to Avoid the 7 Biggest Mistakes That Real Estate Investors Are Making in Today's Market, which goes a little bit deeper into some of these topics we discussed. Purely free educational stuff for you there. Also tells you a little bit more about Maverick. Also on that page, though, you can register for a personalized video consultation with us, right? One of the very cool things about Maverick, Ben, and this is probably my favorite part about our business model, is that we are a real estate brokerage. And in the United States, 100% of brokerage fees are paid by the seller. 0 are paid by the buyer. And the beautiful thing about that is we never, ever have to charge our clients any money at all to work with us. So we will do video consultation with you for free. We want to get to know you, understand your buying criteria, your real estate investment goals, all of that kind of stuff, and to help you to build a plan to build your portfolio of cash flowing rental properties over time, to diversify across markets, all of that stuff. So we like to work with everybody on a very personalized basis, and we don't charge you any money at all. The only way that Maverick makes money is in the event that we can help you find a property that's the perfect fit for you, passes all your due diligence, and you decide to close. Only then do we make money, but not from you. We get paid 100% by the seller of that property. So you can work with us with no cost to you at all. And we would love to meet you. And any listeners of this podcast are super, super welcome at Maverick. So the website again, maverickinvestorgroup.com/invest in alts. And we'll link that up. And we look forward to connecting with your listeners, Ben.
Awesome. Yeah. And we'll put all of those things in the show notes, but really appreciate having you on, Matt, and all that you do. So enjoy your European travels for the summer. And yeah, hopefully our paths cross some point in the near future, man.
It's been a while, man. I haven't seen you. I was trying to think the last time we hung out in person. I think it was Dubai in 2019 before the pandemic.
Yeah. Yeah, it was.
We gotta make this happen, man. At some point over the next year, we have got to be intentional about crossing paths, because I miss you, brother, and I appreciate you having me on.
Down. Likewise. Well, wishing you all the best. Really appreciate it. There you have it. Thank you for listening. I really appreciate your support. Show notes, transcript, links, and more can be found on our website at altassetallocation.com. If you'd be so kind, please share this with anyone you think might be interested or get some value from this conversation. If you have any questions or comments, please reach out. I'm always happy to hear them. Lastly, if you're on YouTube, please like the video or subscribe to the channel. If you're listening to the audio version of this, please subscribe to the podcast and or leave a review. This really helps more people find the podcast, and I really appreciate it. Thanks again, and hope you have a fantastic day. Happy investing.